Investing News Network, and we're here with Jeffrey Christian, Managing Director of CPM Group. How are you?
Very good.
And I wanted to just start with gold. So we know in 2017 it surpassed 1,300. What do you see happening for gold in 2018?
Well, we're kind of looking for only a modest increase in 2018. I think the first half of the year will be relatively flat. I wouldn't be surprised to see it get up to 1340, 1350 yet this month or so, but then come back down to 1250 or 1280 and sort of trade sideways in the first half of the year. In the second half of 2018, we think you'll see some acceleration in gold prices with even further acceleration in 2019 and beyond.
And I know some people have been mentioning that cryptocurrencies are taking away some of the investment from gold. What do you see happening there?
I've been a big skeptic of that and a critic of that theory. I mean, if you look at what's happening in the gold market and the financial markets, our view is that what's been distracting investors from gold is the stock market. If you think about it, the stock market is a $70 trillion market with quadrillions of dollars of derivatives trading against it. The gold market's about a $3 trillion market with several trillion dollars of derivatives trading against it. And the cryptocurrency market is about $500 billion. So if you do a little diagram of the size, relative size, you know, equity market's gigantic with billions of investors worldwide. The gold market is gigantic with billions of investors worldwide. And the Bitcoin market and cryptocurrency market is a minuscule sideshow with fewer than 1 million people estimated to be investing in it. So when you say, well, I think that investors are not buying gold because they're investing elsewhere, I think what they're doing is they're investing in the stock market, which has been moving steadily higher for 10 years now with extremely low volatility. And there have been some people who have probably moved into Bitcoins from a speculative trading perspective away from gold. But we think the vast majority of the money that's not being otherwise invested in gold is being invested in stocks, not in cryptocurrencies.
And there's been some concern as well about a market correction happening this year. Is that something what are your thoughts on that?
You mean in the stock market?
Yes, in the stock market.
Yes. Our view is that you probably will have relatively decent economic performance this year with gathering long-term storms. And I wouldn't be surprised to see a 10, 15, 20% market correction in the S&P 500 or the Dow Jones over the course of the year. It's interesting to note that other countries' stock indices haven't done so well. Longer term, we think there'll be a much bigger financial crisis probably 5 to 7 years from now, and then you could see a much larger decline in U.S. equity values. If you look at the relatively shallow economic crisis we had in 2001, and if you look at the big economic crisis we had in 2008, 2009, in each of those instances, the S&P and Dow fell about 50%. So we're looking for a much bigger decline in the long run, but right now we think that, the market has been a little bit overheated in terms of the stocks, and you could see a 10 to 20% decline.
And so moving away from precious metals, what are you seeing in terms of some of the battery metals and the energy metals? You said that you're looking at lithium, and you're going to be talking on that at the conference here.
Well, I'm speaking tomorrow on the outlook for precious and energy metals. And we're on record as being relatively skeptical about the need for new lithium mines. Even if you do see electric vehicles come in as a major form of motive power, it's going to take a lot longer than a lot of the lithium mining promoters have said. And you have a tremendous amount of established lithium production. I can see new mines in Chile and Argentina where the deposits are much richer, but I really can't see the need for so much lithium as to warrant higher cost new mines being developed elsewhere. In addition to which, if you do see electric vehicles come along and you do see them using lithium-ion batteries, you'll have such an explosion of demand in lithium that you'll start seeing the lithium actually recycled from the batteries. Right now, lithium-ion batteries don't have the lithium recycled. It just gets burnt off because it doesn't make economic sense. But if you had a major electric vehicle market using lithium-ion batteries, then you probably would see lithium recycling. So I can be bullish on electric vehicles and lithium-ion batteries and still bearish on lithium mining, new lithium exploration and development mines outside of Chile and Argentina. You know, in addition to which, you don't know that it's going to be electric vehicles, and you don't know that they're going to be using lithium-ion batteries, because the technology has the potential for changing over the next 5, 10, 20 years.
So then would you say that the rise we've seen in lithium prices, is that something that may not last in the longer term?
The rise in lithium prices that we've seen over the last few years is reminiscent of the previous rise in rare earths, which fell back to earth, and molybdenum, which fell back to earth. It's a short-term factor, partly driven by market fundamentals, but more driven by investors seeking to buy lithium because they've heard that it's the next big thing.
And while we're at it, is there anything else that you wanted to talk about? Anything that's been on your mind?
Oh, there's so much that I've been on my mind. You know, when we talk about gold and silver, we spend a lot of time looking at global economics and financial markets and politics. And then when we talk about energy metals, we talk about emerging energy technology. And in between of those two things are the platinum group metals. They sort of they are precious metals. They're not financial assets in the same way as gold and silver, but they have some of that. But they're also energy metals, if you will, because they're used in auto catalysts. And a lot of people have been deprecating them because they think there's going to be this very rapid transition to electric vehicles. We usually take our long-term projections out 10 years. Last year when we did our platinum group metals projections, we took them out 33 years because the changes that are coming in automotive propulsion technology are not going to really emerge in any meaningful way in the next 10 years. It's going to be between now and 2050 before you really start seeing how energy propulsion technology shakes out.
So then can we expect the palladium rally to continue? Obviously in 2017, palladium really took off, surpassing platinum.
Palladium's been rising for a variety of reasons. And a big part of the increase that we saw in 2017 were investors moving into palladium. You also have what they call congestion in the New York Mercantile Exchange futures delivery system, which has caused these spikes up in May, June last year, August, September, November, December, into January. And that will continue for a while. We have very high open interest in the March NYMEX futures contract. We'll see palladium prices strong in February and March because of that. But at some point that gets resolved. And when that happens, the palladium price can come off $100 or 10% easily.
Great. I'm pretty much out of questions. Thank you so much, Jeffrey.
Okay, it's always a pleasure.
Yeah. So Jeffrey Christian, with Managing Director with CPM Group, and I'm Melissa Shaw for the Investing News Network.